Year-end tax planning tips, strategies, and action steps right now on Retiring Today. Hi, I'm Molly Nelson here with Haley Gutschenreiter and Lauren Merkel. They're both certified financial planners, and Lauren is also a certified financial fiduciary. We're talking about tax planning today, and April 15th, an important date, but maybe, Haley, not even the most important date to put on the calendar when it comes to tax planning.
No, I would actually say December 31st would be one of the most important dates to put on your calendar, because every December 31st that goes by and you did not have an intentional tax plan put in place could be a big missed opportunity to save in taxes and otherwise increase your spendable income in retirement.
And that's the whole reason we're doing this show today. We want to give people tips and action steps because, Lauren, you've been helping people retire, for over 20 years now?
It's been a while.
We're dating Lauren here a little bit, but you have seen how a tax plan can really put more spendable income into retirees' essentially pockets.
Yeah, because you've been saving underneath your retirement plans for 30, 40 years. And for the vast majority of that time, most of the tax savings opportunity you have had is to not pay taxes on the contributions to those plans. But when you retire and you start taking money out, all of that contribution plus the growth you will pay taxes on. And that's where that tax bite can really come up to nip you in the proverbial.
I know
where I'm going?
Yes.
Thanks for not making me go there. It can be painful is the point, but there are action steps that you can put into play by creating your tax plan, and then you can save a bundle on your retirement tax bill, but you have to get started, and waiting until April 15th means you could actually miss some of those most important deadlines.
And talking about having to get started, what age should people start thinking about some of the strategies that we're going to be talking about today?
I would say as soon as possible, because the more that you can plan for your tax bill and retirement, the more you're likely to save. And the truth is that everybody's retirement plan, their tax plan, is going to look very situational dependent on what your income looks like. So the sooner that you get started on this, the better. That's why when we meet with families, this is one of the very first things that we'll start talking about when we build out their retirement plans, because we know that you can save hundreds of thousands of dollars potentially in your retirement tax bill, and that just means more spendable income in your pocket.
Okay, we promised 5 year-end tax saving strategies, so let's get right to it. Number 1, Roth conversions. People hear a lot about these, but they definitely want to make sure it's crystal clear to everybody what it is and what the advantages are.
Yeah, so let's start with what is a Roth conversion. Essentially what you're doing is you're taking the money underneath your pre-tax IRA or pre-tax 401k plan, and you're shifting it over into a Roth IRA or your Roth 401k plan. Now, in the year that you make that shift, move the money from pre-tax to Roth, you will pay taxes on that amount that you move over. So you want to be very careful, you want to be very intentional, and make sure that you're moving not too much, not too little, just the right amount, if in fact a Roth conversion is right for you. Now, the benefit of doing that is once that money is underneath your Roth, it grows tax-free forever. You take it out later down the road, a qualified distribution, use it for income, use it for gifting, use it for whatever you want, and you are not taxed on any of those qualified distributions. So it can be a really powerful retirement tax bill savings strategy if you implement it the right way.
And Haley, is this a year-end tax planning strategy because you have a better idea of what your income is going to be near the end of the year? Is that make a big difference on Roth conversions?
Exactly. So each year your income could look very different. You don't know if you're going to come into an inheritance. You may have a buyout from a severance when you left your retirement, or when you left for retirement. So it isn't a year-end decision because that's when we will be the most accurate as far as what we predict for your taxable income to be in that year. And then that way we can fill up your tax bracket in the most effective way possible to ultimately save you in your retirement tax bill.
And that's one of the strategies where the 12/31 deadline really comes into play, because if you wait until January, February, March of the next year, you could still do a conversion, but it doesn't apply to the last year. It applies in that year, that calendar year that you make that conversion. So you want to make sure it works within the year that you do it. And you don't want to wait till the very end of the year. You don't want to wait till Christmas and say, I'm giving myself a Christmas Roth conversion, because it does take some time. And most of the time we're telling the families and individuals we work with, we want to start on this paperwork no later than 12/1 to make sure that there's ample time to get it done. Because if it happens January 1st, then it's on that next calendar year, not the year you intended.
Okay, great tips. So let's go to the next tax planning year-end tax planning strategy. Number 2, realizing losses and gains. Why is this important?
It's important because underneath non-IRA accounts, there are special tax laws that are not applicable to IRA accounts, in which you can sell off shares of an investment that you have appreciation, you have some gains, you're going to be taxed on those. But within almost every portfolio, no matter how good the markets have been, there are some losers underneath that portfolio. So if you can sell some of those losers and combine it with the profits that you had in some of your winners, then in fact you can eliminate, in some cases, or decrease the overall tax bill on that take the profit strategy. So many times people set it and forget it, and that's not a bad strategy, but from a tax standpoint, if you can take some profits off the table and reallocate, that can help your overall risk in the portfolio. But you can also decrease or eliminate those taxes by selling off some of those losers and realigning your portfolio to more appropriately align with your risk as the markets go up and down.
And I want to jump in here too, because I know what maybe some of you are thinking, right? We're saying sell off some losers to basically mitigate your gains, but everybody's always been taught not to sell low.
Right.
And so this can be an effective strategy. We are saying, hey, let's sell off some losses to mitigate the gains. But what you can do is 31 days from the sale of that losing position, you can buy back into that. So if this is a position that you are confident in that will come back up, maybe in a different environment, you can buy back that position 31 days later.
Is this where capital gains tax rates come into play? And then is that part of the strategy when you're deciding how much or how little to sell off?
Yeah, and that's why we say non-IRA accounts can be tax favored as opposed to pre-tax IRA accounts, because capital gains rates are anywhere between 0% all the way up to 20% based on your total income, as opposed to your ordinary income tax rates are going to be anywhere from 0 all the way up to 37%. So you could pay more at your ordinary income level, the IRA distributions, than you can the capital gains that you would have in this non-IRA account. So it's important to understand what type of tax implications you would have when you engage in this type of strategy, but it can be really effective, especially in a market environment like a 2020. In a 2020, we were really using this type of strategy because what happened in the first half of 2020, the markets went like this. But there were a whole lot of positions, a whole lot of stocks we were confident in long term, but the economic environment was as such, everything was going down. So we could take some profits, some long-term profits, and negate that tax bill with selling off some of the losers. But then after 31 days, we could buy those back. But what happened, there was two benefits there. One is you don't have to pay as much or any tax on the gains that you realized, but your portfolio didn't continue to go down with the market because the market just kept going back down. And after 31 days, you bought in that stock at a lower price. And then eventually the second half of the year, everything came back up, didn't pay a lot of tax or any tax on the gains, and you had a better position in the stocks that you liked long term.
And is the 31 days, does this matter for the strategy? Well, I'm thinking year end here. Do you want to try to do this 32 days or more before the end of the year, or does it matter on the buyback if you did that then the following year?
It wouldn't matter. Okay. So yeah, you could do the buyback on the following year.
Okay,
so as long as you realize those gains where they're mitigating each other before the 31st of the year, then you're fine. You can do the buyback later.
Number 3, take a look at CDs.
Yeah, so really since 2022, we've gone through a series of interest rate hikes. And so now people can actually put their money at the bank somewhere safe and earn a decent rate of return. But what happens when interest rates go down? The feds have been talking about decreasing rates, and so it may look attractive now to go get a CD at the bank, but if that CD is only going to be a 12-month term, what's going to happen in 12 months from now? So it's really important to look at the CDs that you have, and we should reassess, can we do better? Are there better options out there that we can lock in a higher interest rate for a longer period of time? Because if the feds do cut rates, you're going to be happy you are in that longer term at a higher yield.
Yeah, with the safe money, really use a bucketed approach where any safe money that you need to have access to within the next 12 months, that's perfect for the bank CD, 6, 8, 9, 12-month CD. But any money you're not going to need to have access to that you want safe after that 12-month period, now there's alternatives out there that you can get the same or even a higher return and take advantage of interest rates while they're high, lock them in for a longer period of time. So now's a great time to get creative, think outside the box. Let's not just rush to the bank with all of our safe money. There's alternatives out there that can produce a higher return.
And And when the CD matures, is there some tax implications if you don't renew it or is renew the right word?
Yeah,
Yes.
it is.
Yep. So you do pay interest when the CD matures. So that will count towards your income and you would be taxed on that.
So something you'd want to look at. I'm thinking of the year-end implications as well with the CD.
Oh yeah, absolutely.
Fund your accounts. Yeah, if you haven't fully funded them at year-end is a good time to do that.
Year end is a good time to evaluate. Do you have extra money that you can put away for your retirement savings? Because your employer-sponsored plan offers you a really nice opportunity to put a bunch of money away. And there's a special law now that is in place starting in 2025 that if you are within the age of 60 to 63, they call it the super catch-up.
Super catch-up.
So years ago, they implemented the catch-up,
Yep.
which is really nice. And that catch-up, if you're over the age of 50, is $7,500 extra that you can contribute. But the super catch-up, the extra is an extra $2,500 on top of the $7,500 that you can contribute in addition to your regular contribution. So it just helps propel your savings further if you can afford to put that away. But you need to identify that prior to the deadline to make sure you can take advantage of either the tax-free contribution or the tax-deferred contribution, whichever is right for you.
And this is something that's totally separate from an IRA contribution. So an IRA contribution, you can only contribute up to $8,000 a year. And so if you do have extra savings that you're looking to pile away, this could be a great opportunity to really max out your 401ks because your 401ks have a way bigger contribution limit. And that's one of the most efficient ways to get money into a Roth, especially if your 401k plan allows that.
Great tip. Let's look at number 5 here, year-end tax planning tips. Review, that is, your charitable giving. What should people do?
One of the most effective charitable giving strategies today, based on the tax law that is present, most people, when they file taxes, use the standard deduction in excess of 90%. So if you're giving to your favorite charity, there's not really a tax benefit by just giving cash or writing a check like there used to be because you used to be able to itemize. However, if you're 70 and a half or older, and you take monies direct from your pre-tax IRA, it's called a qualified charitable distribution, send that money direct to your charity, then you don't have to pay any taxes on that gift, and it does satisfy your required minimum distribution if you're required to take a distribution from your IRA as well. Now, most people today are not mandated to take distributions from their IRAs until age 73 or 75, but if you're 70 and a half, the QCD option is still an option for you, even though you're not mandated to take distributions yet.
And I think it's also important to note that a lot of people, when they hear about Roth conversions, they think the goal is to convert everything in an IRA over to a Roth. But if you're charitably inclined, you don't want to do that because if you can give out of an IRA and never have to pay taxes on that, that's actually going to be more beneficial than doing a conversion where you would pay the taxes on the IRA, shift it over to the Roth, and then give it from the Roth. So that's one reason why you may want to leave some IRA funds behind is because you can give from the IRA and never pay taxes on that.
And if you start doing that at 70 and a half, when those RMDs kick in, whatever's left, those RMDs will be a little bit smaller. And I know RMDs are a big part of the conversation for John and Sue in the Journey to Retirement workshop because you work to reduce those RMDs and reduce their overall tax implication or tax bill rather.
Another name for RMD is tax ticking time bomb.
There you go.
Because if you're not aware of what the impact of your required minimum distribution is going to be, for many people, it is a tax surprise. And once you are RMD age, you're already taking your Social Security. You're not going to turn that off. You don't want to turn that off. And if you have a pension, you're already taking the pension. That's not going to get shut off. And then you have this mandated taxable amount that you have to take out, pay taxes on, which does shoot people into a higher tax bracket potentially forever. So in the online Journey to Retirement workshop with our hypothetical couple, John and Sue, we show you how they minimize their required minimum distribution and what strategies they use to propel their spendable income, increase their spendable income throughout the course of their retirement, but at the same time, decrease their retirement tax bill.
This is Retiring Today, and we thank you for watching.
Thanks for tuning in. If you enjoyed this video, click here for more fun and exciting content. And don't forget to subscribe to join a community of other like-minded individuals who are also exploring fun and creative retirement strategies.